This is Dr. Dennis B. Anderson. This video is being recorded during early May 2023. It will be better understood if you have read my book, E-mini and Micro E-mini Trading. This book has a gold and green cover. You should have also looked at my prior YouTube videos. For additional information, you might want to review 151 weekly blogs I wrote between February 14, 2019 and January 4th, 2022. That blog site address is AndersonEMiniTrading.com. This video builds on all prior information. You might want to put your E-mini trading platform on another screen so you can follow along. All times on the chart are East Coast times. My books have been selling in 8 countries, including Australia, Japan, the US, Canada, Great Britain, Germany, Denmark, and Italy. Asian bourses open during the evening Eastern time, and European bourses begin actively trading around 3 a.m. Eastern time. When looking at daily charts, we can see a 24-hour chart, but don't easily know how much of a daily 24-hour gain there was before the U.S. markets began actively trading. That's why I often use the term about when describing trading practices. Also, with daily charts, I recommend using market orders. Let's start by looking at a recent chart that illustrates how easily you can make profits with a 15-minute intraday chart. All 15-minute charts should be monitored, preferably no stops, and closed by end of that trading day. On May 5th, which I'm highlighting on the screen, if you bought only one contract of the NQ at about 9:35 a.m. Eastern Time and sold at 3:30 near the close, profits would have been about 195 points or $3,900. Now let's look at this chart. It follows along with everything else that I've written. The pink line for me is the 3x or 3 exponential. The blue line is the 9x or 9 exponential. And when you have to have at least half the green candle above the 9x, then if the next candle opens, moves higher, that's when you buy. So, excuse me, you would buy there at about 13,140. Now you see it stays above the 9x. The only time you need to get worried is if it closes below the 9x, which might indicate a change of direction. But you see it continue to go up here. We're at 2:30, 3 o'clock. Now you've had a good run, and this is within about 4 hours. So you hit a red candle here, which means it's going down on that candle. This is a place where you probably want to take your profits before it goes too much lower. And here then we have a candle that shows indecision, and you should sell in this area there. So if you would sell about 13,140, that would give you, 13,345 after buying at 13,140, that would give you your $3,900 profit. I'll leave this up while I talk a little bit about the daily chart. I want to use the NQ as a trading example. I have slightly modified how to profitably trade a revised Model 1 with the daily chart. After trading the E-minis for more than 10 years, I studied how I might spend less time looking at a screen. This adjusted model only requires about 12 to 15 round-trip trades per year, but has the potential to make more than $9,000 per month with only one contract of the NQ. This approach is only for daily trades with Model 1. I don't trade all the time, but I sometimes trade more than one contract. And the first 4 months of this year, as at the end of April, my profits were about $150,000. You need E-minis with the greatest volatility ranges. That would be the NQ and the YM. The NQ is nearly twice as profitable as the YM, but the YM margin is much less, as is the risk. Trade only one contract until you get comfortable. And of course, you can use the micro minis to get started as well. If you're not experienced with it, I would recommend that. You could have two charts on your screen and trade either the NQ or YM, whichever is giving the best signals. Their trading patterns are fairly different. This is a daily momentum model, so price will usually follow the initial direction for several time periods or candlesticks, whether that's 15 minutes all the way up to a day. Feel free to look at prior daily trading histories of any of the E-minis. At least 80% of the time, if trading long, the later downward cross of the 3X is higher than the upward cross of the 3X where you went long. And the opposite for a short, the rising cross of the 3X is lower than the lower cross of the 3X where you went short. I know that's confusing, but the point is, if you go short, whenever you cover that short, you're probably lower than when you started. And the opposite is if you go long, when you sell, it's probably higher than when you bought in. You could just watch and trade crosses and likely make a reasonable profit with few losses. There are times, of course, when something surprises you and the crossing situations will have a small loss only, or you might break even. I'm going to go through the charts from January through April, and I'll point those out in just a minute. This modification of Model 1 with a daily chart is more straightforward. The regular Model 1, which is designed for all time frames, describes waiting for the 3X to cross above the 9X when going long, and a green candle that is at least half above the 9X, then buying if the next candle opens and moves higher. This extra time and evaluation is necessary because there's a great deal of short-term chart volatility with shorter time frames. You need to hold back a little to look for confirmation. So trading only a daily candle with either the YM or the NQ, this is what you do. Determine if you're in the lower or higher half of the trading range over the past 3 months. You do that, of course, by putting your candle at the high and the low and adding those and dividing by 2. You separate the top half from the lowest half. You have a better chance of a positive trade if you go long when in the lower trading range because there's more upside. The opposite is true when looking into a short trade. Depending on the current strength of upward momentum and the reasons for a short trade, you have a greater chance of a profitable trade if you're going short while trading in the upper half of the trading range. What you do now is look for a place where these cross. Hold on a second and I'll here we are at January 9th. Now this first cross on a daily chart on January 6th, you see the 3 crossing above the 9. And in this case, we have a nice run. By the time it gets all the way up here and crosses back under, you're significantly higher than down here. And the same thing appears several places. Feel free to backtest this and look at where these cross. You also look at the stochastic to see if it is moving briskly in the desired direction. Well, I'd like to see at least a 45-degree angle or about that. And you can see here on January 9th, where we get an indication to buy. If you go down here, the stochastic is moving up briskly. And you buy a contract right at or after that cross. I'll talk a little bit more about that in a minute. If you're looking for a short trade, the prior description is the opposite. There, the 3x moves under and below the 9x, and the stochastic is in a downward slant. Here you would see over here on February 16th, you see how this moves down under the 9x. And then here would be your buy point for a short. And you can see how the stochastic is going fairly sharply lower. So that's a clear and simple solution how you enter a trade long or short. Let's stay on the NQ. There are days when it will move up or down several hundred points in a day. On November 10th, 2022, you see the 800-point rise highlighted with this green candle, and you see the strength of the advanced line going upward on the stochastic. You have the cross slightly before that. If you check this day on a 4-hour candle, you'll see what the upward move began about 5 in the morning. In this example, you could buy on November 10th, the day of the crossover. On days of less strength in the move, you might buy the day after the crossover. That provides a bit more confirmation. On November 10th, the candle opens at 10,841 right here. This doesn't have to be exact. It's a fine scale there. Near the bottom of the current trading range, it moves strongly higher and closes at 11,675, a gain of 834 points. At $20 a point, that would be a value gain of $16,680 in one day for one contract of the NQ. There apparently was some strong economic supportive reports, which you need to watch for, that gave you that kind of a push. In the regular model one, you should wait for the second candle to open and move higher. Now here, that had such a run that that would put us up here, which is about 11,690, so you miss considerable profits. Here, the 3x cross happened about the same time as that strong move. On November 30 is another strong move, I highlighted there. That pattern could be bought the day of the big move because it crossed just slightly before the candle on the 30th. The latest you would ever close one of these trades is when the 3x crosses over the 9x, moving the opposite direction. So here it would go up. And if you wait until it crosses down here, you would miss some profits because you have 3 downward candles before you get to that point. So when you have a big run up, you probably should take your profits. For me, if I'm long and there's a strong surge, I will, if I'm watching the market, I will probably take some profits, like this surge here on the 13th. It spikes higher by 340 points, which is $6,800. If you caught just half of this spike between the candle top here and up here, you would make $3,400 just on that part for that day. If you have an opportunity like this, go ahead and pocket your profits. You can always get back in if it keeps going for you. If the market starts to turn against you, take your profits. Don't wait for that cross. Trade with market orders. Don't try to use limit orders to squeeze out a few points. Too often, after entering a limit order, you sit and watch as the market races away from you. Market orders should be used on daily trades, and they usually average out. Sometimes in a strongly moving market, you find yourself trading both directions at about the same time. There is a reverse button on most platforms. It's shadowed over here on the right. If you click that, you'll instantly close one position going one way and open a position going the other way. You might consider using this approach if price has crossed over on a strong opposite direction move. Now let's get down to some nitty-gritty and look at the trades that were made the first 4 months of this year on a daily chart with the NQ. And I'm going to spend quite a bit of time here pointing those out to you. So here before, at the end of the month in December and early January, there was no trade here. Markets are settling out for the year. And here we are again with this strong move up. And then you would have a buy signal right here, that second candle. So you'd buy about 11,125. And then that continues to run up here. Like I pointed out a moment ago, it doesn't go under. So that runs up here. And now you get a spike up here. And you could sell up there if you wanted. You're still high up here in the stochastic zone, but you had a tremendous run. Particularly this candle ran up about 350 points, and then this one pushed up higher, but then the sellers came in and you see it came back down. If you don't sell on this spike, I would sell on this red candle, the down candle here. Take your profits. And you can see that you'll find this out later. Of course, you can't see it at that day. But as you look back now, you see there are 5 candles here that all topped out about 12,740. That's resistance at the top. So you would sell about 12,720. And that's about 19 days or 4 weeks. And you make, on this little run here, $31,900. On February 17th, this is another buy point. This hasn't gone halfway under. Conservative, you could buy here right after this starts going down. You see the stochastic is moving nicely. Or you could be more conservative and wait to buy on that candle on the 21st. But this is a weekend, so the one before that is the 17th. So let's say we short there at 12,430. You don't know when the move started, so we go down a little bit on this candle. March 2 has a shorter tail hammer at the bottom. See this down here. At the bottom, when you have the price driven lower, the bottom of a run here, and then it comes back up. If it starts moving higher the next day, that means there's going to be a direction change almost always. So it comes back up here, you're short coming down. So you would buy in here. at about 12,430, I should say cover, and then 12,075 you cover for 355 points or $7,100 in 10 days. There's more information about the hammer candle on page 72. And then back before here, I didn't mention it, there's a hanging man candle, which is on page 74. That one was negative and it needed confirmation. I don't want to get too deep in the weeds here. So let's move on. March 6th, there's a strong buy signal. I'm sorry, March 6th here with the rising stochastic. But you just had a big run up the day before of, I don't know, 250 points or more. And so this might be positive, but you see on this candle here, it went up and it came down. But once that candle is green, I might pause a little bit to see what happens that day because it had a good run. And it's possible it could move back down and have a sell-off here the next day or two. And it does here on March 7th. It comes back down. So take your profits. Now here, March 9 is another situation. If you did this on a 4-hour chart, you could short here since it crosses right before it gets there. You could short right under the 9X here. Conservatively, you probably should wait until you get down here to the 10th. But if you're watching this and you short and it turns out to be a bad trade, you might lose a few $100s, but you always have the chance of making a few thousand. So that's up to you. But if you short here, March 4th, I'm sorry. So let's say we didn't short there, we're waiting to buy. And we get over here, here's March 14th. You could buy, you got a strong stochastic starting down here. You could buy about 12,200 right in this area, about halfway up the candle, since it crossed right before that. Or more conservatively, you could wait for up here. But if you buy, let's say 12,200, and you run up here, here we are again with a form of a doji after this three big run-ups here at the top. You probably want to sell up here and take your profits. And that's about 1,000 points, which is $20,000 in 2 or 3 weeks. So you close that position and take your profits. There's one other one here. After you take your profits on April 3rd, the market is pretty inconclusive here. This goes down, but this is not a very good looking candle to make a change with, and it's a big up move again. So we're very volatile here and inconclusive. Now here you could sell again on April 21st at about 13,100. Here it runs down, but then the buyers come in, push it up a little, and now you get a spinning top, indecision candle. That means it's probably going higher, particularly now if it goes up the next day. It does. So you would buy this back at about 13,000. Now you go long again on April 27. And then you get out once again when it starts to come down up in this area here about May 2nd. So the summary of this for the first 4 months this year was about 4 or 5 NQ trades in 4 months with a profit of $61,000. That's a profit of $15,000 a month trading only one contract. That's not going to happen every month, of course. That's why I kind of conservatively put it at $9,000. I've had real good luck with this. I traded most of these trades that I showed you today. And now I'm waiting to see what happens here. We're still in no man's land with national debt and the budget and all of those kinds of things. All right, so wrap up here. Many of you viewing this video work full-time jobs or live in different countries and time zones. Making only 1 or 2 trades a month is less stressful and takes less time. Market prices on a daily chart often have sustained moves up or down, which only require daily monitoring. Most traders trade with daily charts, so this approach fits more closely with what other traders are doing. A bit more capital is needed for a wider trading range, but greater profits can be earned with fewer trades. As I have written before, these positive results will be attained by closely following the model details as I have presented them in the books, daily blogs, and these videos. Don't try to tweak these trading details by adding your own indicators or your own style. I spent several years developing and modifying these models to get them where they are. I likely considered and tested whatever ideas you might have had. Be patient with your learning. Being successful trading E-minis is much like acquiring skills for a vocational trade in a community college curriculum. Discipline and adherence to these model details should provide you with great profits. Thanks for watching this video. I wish you all the very best.